Hello viewers, in this lesson we will learn about the lending and recovery of debts by the banks. Objectives: to learn about the principles of lending in banking business, to learn about the recovery of debts by the banks and the related legislations. Viewers, now we will learn about the sound principles of lending in banking business. The banking business runs on receiving deposits from the public and lending them on interest to the loanees. Lending of funds to the traders, business and industrial entities is the major business of a banking company. The banks try to employ the funds by way of loans and advances in the best possible investment proposals so that they would get good returns which would be shared by the shareholders. Also, the returns would be utilized to pay interest on the deposits made by the customers. The bankers have different types of loans and advances and also accept different kinds of deposits like savings bank, fixed deposits, recurring deposits and like ones. In case of deposits collected, the banker is the debtor to the deposit holders, and in case of loans and advances, the banker is the creditor to the loanees. As per this status, the rights and duties follow. While lending the funds, the banker has to follow a very careful policy and principles of sound lending to minimize the business risk. The law relating to lending by banks. The Reserve Bank of India has issued several master circulars on loans and advances rendered by the banks of different kinds. The central government also evolved a national policy in this regard, and both have to be followed by the banks. These guidelines, circulars, orders are available on the website of RBI and the Ministry of Finance, Government of India. Some of the important areas on which the Reserve Bank of India has issued guidelines are as follows: advances to banks' directors, advances against banks' own shares, restrictions on holding shares in companies, restrictions on credit to companies for buyback of their securities, regulatory restrictions, granting loans and advances to relatives of directors, restrictions on grant of loans and advances to officers and relatives of senior officers of banks, restrictions on grant of financial assistance to industries producing, consuming ozone depleting substances, ODS, restrictions on advances against sensitive commodities under Selective Credit Control, SCC, restriction on payment of commission to staff members including officers, restrictions on offering incentives on any banking products, restrictions on other loans and advances, loans and advances against shares, debentures and bonds, advances against fixed deposit receipts, FDRs, issued by other banks, advances to agents, intermediaries, based on consideration of deposit mobilization, loans against certificate of deposits, CDs, finance for and loans advances against Indian depository receipts, IDRs, bank finance to non-banking financial companies, NBFCs, financing infrastructure, housing projects, issue of bank guarantees in favor of financial institutions, discounting, rediscounting of bills by banks, advances for purchase of gold and lending against gold bullion, coins, primary gold, advances against gold ornaments and jewelry, gold metal loans, loans and advances to real estate sector, loans and advances to micro and small enterprises, MSEs, loan system for delivery of bank credit, lending under consortium arrangement, multiple banking arrangement, working capital finance to information technology and software industry, guidelines for bank finance for PSU, disinvestments of Government of India, grant of loans for acquisition of Kisan Vikas Patra, KVPs, 7% savings bonds 2002, 6.5% savings bonds 2003, non-taxable, and 8% savings taxable bonds 2003, collateral facility. Guidelines on settlement of non-performing assets, obtaining consent decree from court. Project finance, portfolio of banks. Bridge loans against receivables from government. Fund, non-fund based credit facilities to overseas joint ventures, wholly owned subsidiaries abroad and overseas step-down subsidiaries of Indian companies. Transfer of borrower accounts from one bank to another. Guidelines on fair practices code for lenders. Guidelines on recovery agents engaged by banks. Section 20 of the Banking Regulation Act 1949 lays down the restrictions on loans and advances to the directors and the firms in which they hold substantial interest. Purchase of or discount of bills from directors and their concerns, which is in the nature of clean accommodation, is reckoned as loans and advances for the purpose of this section. The Banking Regulation Act and the RBI Act 1934 contain several provisions in this regard. Further, Section 185 of the Companies Act 2013 imposes restrictions on the loans to directors, and if the banks are involved in case of any guarantee, they must follow this provision. Further, for advancing loans to the companies, the provisions of Section 186 of the Companies Act 2013 must be followed. Sound principles of lending by banks. Basically, the banks conduct their business in tune with the national policy of the central government, even though the banks are independent in designing their own schemes of loans and advances. The banks by practice follow three cardinal principles of lending, namely safety, liquidity, and profitability. There are many other sound principles which are evolved in global banking practice. They are discussed here under. 1. Safety. The safety of funds lent is a very important principle of lending. Safety implies that the borrowers should repay the loan and interest on time without default. The repayment of the loan depends upon the nature of security, the character of the borrower, his capacity to repay, his financial standing, and like factors. The bank must take all precautions and follow the lending norms before the advances and loans are sanctioned. 2. Liquidity. Liquidity is another important sound principle of bank lending. Banks lend money for various periods. The banks lend public money which can be demanded back at any time by the depositors. Therefore, the banks advance loans on the security of such assets which can be easily converted into cash, which is called liquidity of assets. The banks choose such securities having good liquidity so that in short notice the banks can convert the properties of the loanees kept as security into cash. The shares and other securities listed in stock exchanges have high liquidity. So is the case with the gold kept as security with the banks for raising loans. 3. Profitability. The banks are business organizations meant for making profit while rendering various services to the customers. Unless the banks make profits, they cannot pay salaries to the staff, interest to the depositors, dividend to the shareholders, and to meet the day-to-day expenditure. Incurring losses by a bank is catastrophic and fatal to the very existence of the bank. Hence, the banks must evolve a viable policy to earn at least optimum profits, if not high profits, to survive in the banking business. 4. Margin money. Margin money means the amount of money the customer has to contribute from his end to avail loans. As for example, if the value of a car is rupees 5 lakhs, the bank may fix the margin money as 20%. Then the customer has to contribute rupees 1 lakh and the bank would release a loan of rupees 4 lakhs. This ensures safety in recovering the loan in case of any default committed by the customer. 5. The purpose of loan. At the time of granting an advance, the banker must ascertain the purpose of the loan. If it is for unproductive purposes, there may be more chances of default. If it is for productive purposes, then there is more chances of repayment of loan with interest. Further, the purpose should not be in furtherance of any purpose which is illegal, unlawful, and opposed to public policy. 6. Principle of diversity. The banks, especially the commercial banks, internationally follow the principle of diversity. That means they invest their funds in different types of securities. They should choose the securities of different types of industries situated in different parts of the country. Diversification aims at minimizing risks of the investments of the banks. The principle of diversity also applies to the advancing of loans to several companies, firms, industries, businesses, institutions, organizations, and trades. The standard formula of diversification of funds by banks is based on the maxim, do not keep all eggs in one basket. The risk should be spread over several investments so that if any loss is suffered from one investment, would be recovered from other investments. The bank should invest their funds in such stocks and securities, the prices of which are stable. The banks cannot afford to invest their funds in such securities, the prices of which are subject to frequent fluctuations. Further, the bank should invest the funds in such types of securities which have high liquidity. Modes of loans and advances. The banks meet the capital requirements of the customers by way of advances and loans, mostly in the form of cash credit system, overdrafts, loan system, and purchasing and discounting of bills. Keeping in tune with the national policy of rendering loans by the central government, the banks also grant different loans of different types, including the microfinance. Further, the loans could be for short term, medium term, and long term based on the repayment schedule. There are other kinds of loans like bridge loans, composite loans, and consumption loans, which are all subject to the RBI guidelines. Presently, as per the government policy, the banks must provide loans to customers such as loans for medical purpose, educational purpose, and also consumer purpose, apart from granting loans for only productive purposes. Classification of loans and advances. The loans and advances granted by banks are basically classified into secured and unsecured loans and advances. Under Clause N to Section 5 of the Banking Regulation Act 1949, a secured loan or advance means a loan or advance made on the security of assets, the market value of which is not at any time less than the amount of such loan or advance. An unsecured loan or advance means a loan or advance not so secured. The assets which can be taken as security could be the tangible assets like goods and commodities, land and buildings, gold and silver, various securities and like ones. The securities also could be personal securities like negotiable instruments, tangible securities, and collateral securities like the factory building, land, etc. Also, guarantee can be obtained for the repayment of loans from third parties, and in this regard, the law of guarantee as enunciated under the Indian Contract Act 1872 applies. Viewers, we will now learn about the recovery of debts by the banks and the related legislations. While lending is one of the prime functions of banking business, recovery of loans and advances is also equally an integral part of banking business. In case of lending and the recoveries, normally the courts will not interfere as it is the discretionary power of the banks to grant loans and advances and put forth the conditions of recovery and also grant any concessions. The Supreme Court in United Bank of India versus Sachavati Tandon and others observed that where statutory remedies are available under a fiscal statute like the SARFAESI Act, the exercise of jurisdiction under Article 226 by High Court could have serious adverse impact on the right of bank and other financial institutions to recover their dues. The meaning of recovery is collection of the due amount from the debtors. If the due amounts are not recovered and continuously the debtors are in default of payment of installments regularly, the loan account would be viewed as a non-performing asset called in short NPA. The survey on recovery reveals that the recovery rate is very poor in India in banks, especially in the public sector banks. The NPAs are on the increase in the public sector banks. The RBI has issued guidelines on NPAs and regulated one-time settlement called in short OTS scheme. Thus, the recovery of loans is a Herculean task for public sector banks in particular and the banks in general. There are different modes of recovery of loans and advances by the banks. They are narrated hereunder. 1. OTS. The banks follow a one-time settlement scheme under which all the due amount is reduced to a mutually agreed figure and payment is made one time so that the documents are released and the properties, if any, on mortgage are also released and the loan account is closed. 2. Compromise. The banks adopt compromise formula where borrowers experience certain genuine difficulties and where normal recovery is not possible. It involves a sacrifice on the part of the banks. Such proposals can be taken up considering the history of the borrower account, security available, net worth of the borrower, guarantee. 3. Recovery camps. In this method, the bank's personnel approach the defaulting borrowers for repayment at a place and time convenient to both the parties. These are more suited to small loans. Normally, the borrowers who had availed small loans will be more in number in rural and semi-urban areas rather than urban and metro centers. As such, the banks, instead of conducting the recovery camps at their branches, they usually conduct such recovery camps in centers like Panchayat board offices, court buildings, government department buildings. 4. Preference of claims. Banks are protected from bad debts through insurance. Indemnity is provided to the banks in such situations from organizations like Deposit Insurance and Credit Guarantee Corporation, Export Credit Guarantee Corporation, Credit Guarantee Fund Trust for small scale industries, insurance companies, etc. 5. Technical write-off. Banks may decide to write off small loans which have become bad and the recovery is not at all possible in those accounts under any circumstances on account of the facts that the borrower might have expired or he has no means to repay the loan at any cost, and there may be huge losses in respect of the properties, etc. This method is used for the purpose of servicing this kind of non-performing assets. 6. Filing of suits. The banks may file suits against the defaulters for recovery of the loans and advances. In such a case, the banks will have to follow the appropriate court procedure. This court process may be time-consuming and dilatory in comparison with other methods. When the value of the loan is above rupees 1 lakh and securities are available, the banks usually invoke the SARFAESI Act. 7. Debt Recovery Tribunals. The Recovery of Debts Due to Banks and Financial Institutions Act 1993 was passed with the objective of facilitating the banks and financial institutions for speedy recovery of dues in cases where the loan amount is rupees 10 lakhs and above. The DRT Act and the subsequent amendments have provided a great improvement over the normal legal forum. 8. Lok Adalats. It is a legal forum for expeditious settlement of loan dues on consensus arrived between the bank and the borrowers, mediated by the Lok Adalat under the Legal Services Authorities Act 1987. 9. Securitization Act. The Securitization and Reconstruction of Financial Assets and Enforcement of Security Interest Act 2002, SARFAESI, aims at empowering banks as secured creditors to take possession, manage and sell the securities without the intervention of court tribunal. It also aims at asset reconstruction by the securitization or reconstruction company. However, a loan with a balance below rupees 1 lakh or unsecured loans and loans against collateral security of agricultural land are exempted from the purview of this Act. 10. Recovery agents. Employing recovery agents is a new phenomenon adopted by the banks both in public sector and the private sector. Sometimes the recovery agents used force against the customers, which was declared as illegal by the Supreme Court and various high courts. In this connection, the Reserve Bank of India framed guidelines which are available in its website. All the banks must follow due process of law for recovery of loans and advances, and using any force or violence by banks through the recovery agents is illegal and also punishable under the criminal law. Well, viewers, I hope you have enjoyed this lesson. We'll meet again. Thank you.